Hello, it is my hope that you is well and doing fine. Welcome to the first topic of financial statement analysis, that is ratio analysis. Ratio analysis is one of the major tools of financial statement analysis. In fact, it is one of the most powerful tools of analyzing financial statements. A ratio can be defined as a quotient of two mathematical expressions. It is a relationship between two or more things. In financial statement analysis, a financial ratio is obtained by dividing one element in a financial statement against another element in a financial statement in order to obtain a financial ratio. Ratios are a powerful tool in helping the users of financial statements in comparing the performance and financial position of a business over time, that is in the case of a trend analysis, and can also be used to compare the performance and financial statements of a business against other businesses, say competing businesses or other businesses in an industry or in the general economy. A financial ratio, provides a powerful tool of analyzing financial statements as opposed to absolute figures. Yeah. So we have absolute figures in the financial statements, figures that stand alone. Say assets standing by themselves alone. Yeah, that's an absolute figure. An absolute figure may not be able to convey meaningful information to the users of financial statements as compared to a financial ratio. A financial ratio is a very powerful tool in helping to determine the relationship between the various items or elements in the financial statements, whereas absolute figures that have not been related to other items in the financial statements that cannot give meaningful information. So take for instance, as shown in the table below, you have two companies there. We have two companies that is Keroche Breweries and East African Breweries, just as an example, not giving the real details here. So you've been given the net profit of Keroche being 500 million shillings and the net profit of EABL being 1.5 billion shillings. These are absolute figures. Looking at this absolute figure of the net profit, this figure may be misleading. Assuming you don't look at the net assets or the ratio or any other ratio, you will easily say that EABL is doing better than Keroche Breweries. In terms of profitability, EABL is generating a profit of 1.5 billion shillings, whereas Keroche Breweries is only generating a profit of 500 million shillings, which is way lower than EABL's profit. But then, if you compare with another element in the financial statement, say the total assets of the two companies, yeah, and then you derive the ratio of the return on total assets, which will be equal to the net profit divided by the total assets. For Keroche, the return on total assets will be 500 million shillings divided by 1 billion shillings, which will give us a return on total assets of 50%. Whereas East African Breweries Limited, with its net profit of 1.5 billion shillings and total assets of 10 billion shillings, will give you a return on total assets of 15%, which is way lower than the return on total assets of Keroche Breweries. When we introduce this ratio of return on total assets, you can easily tell that Keroche Breweries is more profitable than EABL, that Keroche is deriving more profit on its investment in total assets as compared to EABL. Yeah. So therefore, in conclusion, we can say that a ratio analysis is a very powerful tool in telling the financial performance and position of a business as opposed to using absolute figures as shown in the financial statements. Yeah. When you do a ratio analysis, we get a meaningful information. We're able to draw ourselves into a meaningful conclusion. We're able to make a decision that is well advised when we use a ratio analysis. Yardsticks of ratio analysis. So in performing a ratio analysis, we have some standards. We have some yardsticks to compare. Financial statement analysis is mainly about comparing. We compare this business against this other business, or you compare this business performance against its performance some few years ago. So we have several measures, yardsticks or measures of performance. One, we have the past performance of the company. Yeah. So in this case, we are comparing the performance and financial position of a business now and the performance of the same company years ago or years before. So or yeah, years in the past. Yeah. So in past performance, we can use the past performance as a yardstick, yeah, so as to be able to tell whether the business is improving or not. So past performance can be a yardstick of ratio analysis. So we derive a ratio analysis say on profitability, say the gross profit ratio, and compare it with the gross profit ratio of the previous years. Another yardstick of performance used in ratio analysis is average industry ratios. Yeah, so we all know that an industry is a collection of companies, yeah, that produce the same item or the same product. So we can use the average industry measures to compare the performance and financial position of our business. Yeah, so we get the average and be able to tell the position at which our business is in the industry. So this is by obtaining the ratios of the entire industry and then comparing these ratios with the ratio of our company or business. Again, as a yardstick of performance and a ratio analysis, we can use the ratios of successful companies. So this is a case of benchmarking. So we are a young company, we are benchmarking with a strong company in the economy. Yeah. So for instance, we are at the East African University, a very small university. We want to compare our performance vis-a-vis the performance of a big university in the country, say the University of Nairobi. So bigger companies can be used as a yardstick for benchmarking. We can also use number 4 as a yardstick of performance and ratio analysis, the ratios of budgeted performance. So as managers, we need to have goals to achieve. We need to have profit goals. So these profits will also we have ratios for profitability, like the gross profit margin, like the net profit margin, like the return on total assets, return on investments as profit ratios. So we need to set goals to achieve. So then after setting these goals, then we need to assess our actual performance and compare this actual performance against the set goals. So ratios of budgeted performance can also be used as yardsticks of ratio analysis. So under ratio analysis, we mainly have 5 pillars of ratio analysis. Yeah, the classification of ratios. Yeah, I prefer to refer to them as pillars of ratio analysis, and they are mainly a total of 5 pillars of ratio analysis. That is profitability ratios, we have market test ratios, we have turnover ratios, also known as the efficiency ratios, we have the liquidity ratios, and we have the leverage ratios. So look at each of these pillars one by one. So the first classification of ratios is liquidity ratios. So liquidity ratios measure the liquidity of a business. It measures the capacity of a business to pay its long-term debts, to pay its short-term debts as and when they fall due. Or rather, we can also say that liquidity ratios measures the ability of the business to convert its current assets into cash in order for it to be able to pay its current liabilities. So that is liquidity, yeah, the measure of the company's capacity to pay its short-term debts, and that is from short-term assets. Its ability to convert its short-term assets into cash so as to pay short-term debts. So under this pillar, we have 3 ratios. We look at 3 ratios. That is the current ratio. We have the quick, also known as the quick asset test ratio. And we also have the cash ratio. Then the second pillar of ratio analysis is profitability ratios. These ratios, the profitability ratios measure the profitability of the business. Yeah, they measure the company's ability to generate returns on its resources. So they generally measure the profitability of the business. Examples of of profitability ratios. Examples of profitability ratios. We have the gross profit margin, the operating profit margin, the net profit margin, the return on investment, the return on equity, and return on capital employed. We shall look at all these ratios in details later in this video. Then we have the turnover ratios, also known as the efficiency ratios. These ratios measure the efficiency of the business. Yeah, they measure the efficiency with which the firm utilizes its assets. Yeah, to generate profits. Yeah, efficiency has to do with minimizing costs, minimizing usage of resources, so as to achieve our objectives. Yeah. So turnover ratios indicate the efficiency with which the firm utilized its assets or resources at its disposal to generate sales revenue or turnover. So some of the efficiency ratios we have is stock turnover ratio, stock holding period, we have the debtors turnover ratio, debtors correction period, creditors or accounts payable turnover ratio. We also have creditors payment period. We have the fixed asset turnover. We have the total asset turnover, and we also have the working capital cycle. So these are ratios that measure the efficiency of a business. The firm's efficiency in terms of minimization of losses, in terms of minimization of wastage of resources, and in terms of maximization of the usage of its assets. So out of the assets that we have, how much profit can we generate from this? The higher the profit we generate from the assets we have, the more efficient we are as a business. And then we have the fourth pillar of ratio analysis, that is the gearing ratios. The gearing ratios look at the capital structure of the business. They look at the mix between debt and equity in the capital structure of the business. Yeah. So they explain the extent to which debt is employed in the capital structure of a concern. Yeah. So they measure, basically, leverage ratios measure the mix of debt and equity. The higher the debt in the capital structure, the more geared or the more levered the company is. And the lower the debt in the capital structure of the business, the less geared the company is, or the less leverage the company has. You know, more debt in the capital structure, the higher the risk of insolvency, the risk of going under, the risk of not being able to operate further because the business may have all its cash taken by creditors. The business will be left illiquid. If the business doesn't have enough cash, the business may cease to operate. So as such, the business needs to keep an optimum level of capital structure where the debt is at the optimum level. So the gearing ratios, also known as the leverage ratios, and the capital structure ratios measure this mix of debt in the capital structure of the business. Examples of leverage ratios we have is debt to equity ratio, we have the debt ratio, and we have the times interest earned ratio, also known as the interest coverage ratio. And then we have the fifth pillar or classification of financial statement of ratio analysis, that is market test ratios. The market test ratios basically perform a ratio analysis of the companies in the financial markets, in the stock market. For instance, ratios, we may compute ratios touching on the Nairobi Securities Exchange. Yeah. So ratios, basically most of these ratios will touch on the shares of the company and so on. So examples of market test ratios we have is earnings per share, we have the earnings yield ratio, we have the dividend per share, we have the dividend yield, we have the price earnings ratio, we have the dividend cover, we have the dividend payout ratio, we have the book value per share, and we have the market to book value per share. So now let us look at how to calculate each of these ratios. So we first begin with some of the liquidity ratios that measure the liquidity of a business. So one of the liquidity ratio is the current ratio. The current ratio measures the liquidity of a business, the ability of the business to convert its cash, its current assets into cash in order to pay all its current liabilities. So it gauges how a business is able to pay current liabilities by using its current assets only. It's also known as the working capital ratio. The formula of current ratio is equal to current assets divided by the current liabilities. The higher the current ratio, the higher the liquidity of the business. So as a general rule of the thumb, the current ratio of a business should be equal to 2:1. The ratio of 2:1 for current ratio is ideal, especially for trading companies. Yeah, the higher the current ratio, the more liquid the business is. Then we have the second ratio we look at is a quick ratio, also known as an acid test ratio, which is also a measure of liquidity. It shows a firm's ability to meet its current liabilities with its most quick assets. The quick assets is equal to the current assets minus stock. So therefore, the quick asset test ratio is equal to the current assets minus stock divided by current liabilities. So the higher the quick ratio, the higher the liquidity of the business. Yeah. So the quick ratio is measured by deducting stock from its current assets in order to obtain the quick assets. A ratio of 1:1 is ideal for the quick asset test ratio. Yeah. And the higher the ratio, the more profitable, the more liquid the firm is. And then we have the cash ratio, which is another liquidity ratio that measures the liquidity of a business. And the cash ratio measures the ability of the firm to meet its current liabilities from its most liquid asset. And the most liquid asset is usually cash. Yeah. So therefore, the cash ratio will be equal to cash divided by current liabilities. But in case we have marketable securities that the business has invested in, we add the marketable securities to cash and divide them by current liabilities in order to obtain the current ratio. Examples of marketable securities are short-term investment in stocks. You may find a business having invested in shares of other companies. These shares can easily be sold in the stock market. So they are therefore marketable securities. So a higher cash ratio indicates higher liquidity for the business. So the higher the cash ratio, the more liquid the business is. We scroll downwards to other ratios. We have the profitability ratios, which measure the profitability of the business. We begin with the gross profit margin. The gross profit margin basically measures the profitability of the business from the gross profit. So the gross profit is equal to the gross profit divided by sales. The higher the gross profit margin ratio, the higher the more profitable the firm is. Then we have the operating profit margin. The operating profit margin is also another profitability ratio. So it measures the ability of the business to control its operating expenses and revenues, such as distribution costs, wages and salaries, traveling expenses, telephone, and so on. Those expenses that you find in the profit and loss account. So the operating profit margin is obtained by dividing operating profit by sales and multiplying by 100%. The operating profit is also known as the earnings before interest and tax. Yeah, earnings before interest and tax. That is the gross profit plus other revenues minus other expenses before deducting interest expense and before deducting tax expense. It will give you the operating profit. So the operating profit margin is therefore equal to the earnings before interest and tax divided by sales, which is the same as the operating profit divided by sales. The higher the operating profit margin ratio, the more profitable the business is. A higher operating profit margin indicates higher profitability. And then you have the net profit margin. The net profit margin is also a profitability ratio. It measures the profitability of the business. It's computed by dividing the net profit divided by sales, or rather, the net profit after tax divided by sales. The higher the net profit margin, the higher the profitability of the business. Or rather, a high net profit margin indicates a high profitability in the business. Then, still under profitability ratios, we have the return on investment. Return on investment, also known as the return on total assets, will measure the profitability of the business, and the return on investment will be equal to the net profit divided by the total assets multiplied by 100%. The higher the return on investment ratio, the higher the profitability of the business. A higher return on investment will indicate a higher profitability in the business. Then another profitability ratio is return on equity, also another profitability ratio, yeah, which measures the return, the profitability of business for every 1 shilling invested of equity in the business. So it's obtained by dividing the net profit divided by equity, and then you multiply all that by 100%. The return on equity is equal to the net profit divided by equity. A high return on equity ratio indicates a high profitability. Then we have the other profitability ratio, that is a return on capital employed. This is also another profitability ratio, and it is equal to the net profit divided by the capital employed. Or rather, it's equal to the net profit divided by the total assets divided by the current liabilities. Capital employed is usually equal to total assets minus current liabilities. A high return on capital employed indicates a high profitability. We then move on to the other classification of ratios. We have the turnover, also known as the efficiency, and the assets management ratios. These ratios measure the efficiency of a business, the ability of a business to generate sales from its investment in assets, the ability of a business to minimize its investments and maximize its returns at the same time. So we have, under these ratios, we have the stock or inventory turnover ratio. So this ratio indicates the number of times that stock was turned over, that stock was sold during a given year. That is, how many times did the buy and sell process occur during the year. In short, it measures the activity, yeah, the activity of the business. How many times was stock bought and sold during the year? This ratio is calculated by dividing the cost of sales by the average stock. The higher stock turnover ratio indicates higher efficiency. Yeah? A high stock turnover ratio indicates high efficiency. Then you have the stock holding period. This indicates the average number of days that stock was held in the business. The stock holding period indicates the average number of days that stock was held in the business before being sold. The stock holding period is equal to 365 days divided by the stock turnover ratio. That is, the stock holding period is equal to 365 days divided by the stock turnover ratio. The shorter the stock holding period, the more efficient the business is in utilization of its inventory. So the shorter the stock holding period, the more efficient the business is. Then we have the debtors turnover ratio. The debtors turnover ratio measures the frequency in which the debtors paid their debts, the frequency with which credit customers were turned into sales. The debtors turnover ratio is equal to the credit sales divided by the average debtors. The higher the debtors turnover ratio, the more efficient the business is. The higher the debtors turnover ratio, the more efficient the business is. Then we have the debtors collection period. The debtors collection period measures the number of days it took the business to collect money from its debtors. The debtors collection period is obtained by dividing 365 days divided by the debtors turnover in order to get the period in the number of days. The shorter the debtors turnover ratio, the more efficient the business is in collecting its money from its debtors. So I proceed to the other efficiency ratio, that is the creditors turnover ratio. The creditors turnover ratio measures the number of times in a year that the business converted its credit, the business paid its creditors. The creditors turnover ratio measures the number of times the business paid its debtors during a year. Its creditors. The number of times the business paid its creditors during a given year. The creditors turnover ratio is equal to the credit purchases divided by the average creditors. The higher the creditors turnover ratio, the less efficient the business is. Please know that. The higher the creditors turnover ratio, the less efficient the business is, because the business will prefer to pay creditors at the slowest pace possible, so that you can be able to utilize this money for other activities. So therefore, the higher the creditors turnover ratio, the less efficient the business is. Then we have the creditors payment period. The creditors payment period measures the average number of days that the business pays its creditors during a given year. It is obtained by dividing 365 days by the creditors turnover ratio. The shorter the creditors turnover ratio, the less efficient the business is in managing its debtors. It's ideal for the business to withhold the credit payments as long as possible, so as to utilize this money for other activities. So we proceed to other efficiency ratios. We have the fixed asset turnover ratio, which measures the efficiency with which fixed assets were utilized to generate revenue. The higher the fixed turnover ratio, the better. And the higher the fixed turnover ratio, the more efficient the business is in the utilization of its fixed assets. So the fixed asset turnover ratio is obtained by dividing the sales by the fixed assets. Then we move on to the total asset turnover ratio. The total asset turnover ratio measures the efficiency with which the total assets of the business were utilized to generate sales. It measures the efficiency with which the total assets of the business were utilized to generate sales. The higher the total asset turnover ratio, the better, because it indicates that the firm is quite efficient in generating more sales out of its assets. The total asset turnover ratio is obtained by dividing sales by total assets. So you drop down to the other efficiency ratio, that is the working capital cycle. The working capital cycle refers to the period that elapses between the payment for goods bought on credit to the receipts of cash from goods sold on credit. The working capital cycle is obtained by the formula is equal to the stock holding period plus the debtors collection period minus the creditors payment period. These are periods that we have been able to obtain from above, with the stock holding period being equal to 365 divided by stock turnover ratio, the debtors collection period being equal to 365 days divided by the debtors turnover ratio, minus the creditors payment ratio period, which is equal to 365 divided by the creditors turnover ratio. These are ratios that we have looked at, but I hope that we shall do this practically in an example. So a lengthy working capital cycle is an indicator of poor management of stock and debtors, reflecting low turnover of stock and debtors and a length stock holding period and debtors collection period. So the shorter the working capital cycle, the more efficient the business is. And vice versa, the longer the working capital cycle, the longer the working capital cycle, the less efficient the business is, and the shorter the working capital cycle, the more efficient the business is. Yeah, so the business should should yearn to achieve a shorter working capital cycle, which is equal to the stock holding period plus the debtors collection period minus the creditors collection period. So the working capital cycle should be as short as possible. And the firm can achieve a shorter working capital cycle by negotiating for longer credit with their creditors and pushing their debtors to pay early, and also being more efficient in stock, increasing the activity, yeah, with holding stock for shorter periods. Then we move on to the other classification of ratios we have is leverage ratios, which look at the capital structure of the business. They measure the debt portion, the proportion of debt in the capital structure of the business. So some of these ratios we have under the leverage ratios is a debt to equity ratio. The debt to equity ratio measures the extent of debt in the capital structure of the business. That's leverage. It's equal to the long-term debt divided by the equity finance. Is equal to long-term debt divided by equity. A higher debt to equity ratio indicates high leverage. Firms should yearn to minimize the debt to equity ratio so as to minimize their leverage, so as to lower the exposure to the risk, to the business risk, the risk of insolvency. Then we have another leverage ratio, that is a debt ratio. The debt ratio is also another leverage ratio that measures the portion of debt in the capital structure of the business, and it is equal to the total liabilities divided by the total assets. The higher the debt ratio, the more geared the firm is. So firms need to minimize the debt ratio so as to lower their risk of insolvency. Then we have the times interest earned ratio, also known as the interest coverage ratio. The interest coverage ratio indicates the number of times that interest is covered by the net profit, by the operating profit of the business. The times interest earned ratio measures the coverage of the interest expense by the operating profit of the business. Yeah, it's out of the operating profit that the business pays interest. So the higher the operating profit, the more the business is able to pay for interest charges on debt. Yeah. So the higher the times interest earned ratio, the better for the firm, indicating that the firm is able to generate sufficient profits to cover its interest charges. Then we move further downwards for the uh, other ratios, classification of ratios. The fifth pillar of ratio analysis, that is the market ratios. The market ratios. So the market ratios compare the performance of the business in the financial markets. So under the market ratios, you have the earnings per share. The earnings per share is just like the profitability of the business. It's just like a profitability ratio. It measures the profitability of the business in the stock market. And the earnings per share is equal to the net profit divided by the number of ordinary shares. The higher the earnings per share ratio, the more profitable the business is, and the better the business is in the stock market. Then we have the earnings yield, which measures the cover of the earnings per share on the market price per share. Yeah, the market price per share in the stock market. The earnings yield measures the cover of the earnings per share on the market price per share in the stock market. The higher the earnings yield ratio, the better the firm is. Then we have the dividends per share. This is the dividend paid per share. The dividend per share is equal to the dividends paid divided by the number of ordinary shares. This is the money that the shareholder receives for every dividend. Then we have the dividend yield. The dividend yield indicates the cover of dividend per share on the market price per share. Yeah, it indicates the cover of dividend per share over the market price per share. How many times does the dividend per share cover the market price per share? So it's equal to the dividend per share divided by the market price per share. So the dividend per share is equal to the dividend per share divided by the market price per share. Then we have the price earnings ratio. The price earnings ratio indicates the payback period of the share. Yeah, the payback period of a share. Those who have done financial management, you know that the payback period is the number of years it will take to recoup an investment, to recover the money invested in a project. So in this case, the price per earnings ratio measures the number of years it takes for the business, for a shareholder to recoup the money invested in a share. Yeah. So the the price earnings ratio is equal to the market price per share divided by the earnings per share. The lower the price earnings ratio, the better for the shareholder. And then we have the dividend cover ratio. This ratio indicates the number of times dividend can be paid out of the earnings per share. The number of times dividends per share can be paid out of the earnings per share. It is therefore equal to the earnings per share divided by the dividend per share. The higher the dividend cover will equal to the higher earnings retention ratio. And then we have the dividend payout ratio. The dividend payout ratio is the extent to which the business has paid dividends out of its earnings. The extent to which the extent to which the business or company has paid dividends out of its earnings. The dividend payout ratio is equal to the dividend per share divided by the earnings per share. The dividend payout ratio is equal to the dividend per share divided by the earnings per share. Then we have the book value per share. Yeah, this is a book value as per the financial statements of the business, and it is equal to the equity divided by the number of shares. It is equal to the equity as per the balance sheet divided by the number of ordinary shares. Then we have the market to book value ratio. This indicates the amount of goodwill attached to the firm, i.e. the excess of the sales value of the assets of the firm. It is equal to the market price per share divided by the book value per share. The market to book value per share is equal to the market price per share divided by the book value per share. If the ratio is greater than 1, this indicates a positive goodwill. Whereas a market to book value ratio less than 1 indicates a negative goodwill. And that is it with the financial statement analysis. The rest we have are examples. The next lesson, we shall look at an example on financial ratio analysis. Thank you for paying for your attention. Let's meet in the next video where we shall look at an example or examples. So may God bless you and keep you safe. Thank you.